country with one of the most captive bond markets in the world, a central bank willing to print at will, a political class content to kick the fiscal can down the road for decades. But this week, the illusion shattered. No buyers, no bids, no confidence. Japan's government bond market, the second largest on earth, is breaking down in real time. And if that doesn't rattle you, it should, because Japan isn't just a warning, it's a blueprint for what comes next. The fuse has been lit, and the next explosion could be the United States. Something extraordinary is happening in Japan's bond market, and unless you've been watching very closely, you might have missed just how serious it is. Let's start with a headline. For the second day in a row, there were no buyers, literally no bids for Japan's 30-year and 40-year government bonds. Now just pause. Just think about that. This isn't a junk bond auction. This is the sovereign debt of the world's third largest economy. And the market, i.e. the very investors who are supposed to fund the government, well, they just shrugged. At a 20-year auction this week, the bid-to-cover ratio, which is the key measure of demand, cratered to its weakest level since 2012. The tail, or the spread between what investors were willing to pay and what the government had to offer, was the worst in 38 years. You have to go back to 1987 to see this kind of rejection. And that kind of rejection came with consequences. The 20-year yield soared to its highest since 2000, the 30-year touched levels not seen since its inception, and the 40-year surged to a new all-time high. To put it bluntly, Japan's bond market is breaking. For decades, Japan was the model of bond market repression. A polite, deflationary society, a central bank buying everything in sight, domestic investors with nowhere else to go, a market that could be manipulated indefinitely without consequence. And all that, well, that's now all in pieces. The Bank of Japan pioneered yield curve control, which is not a particularly naughty euphemism for interest rate suppression. It capped yields, printed money to mop up bonds, and told everyone not to worry. And that worked. Until it didn't. Now, the long end of Japan's bond curve, i.e. the bit that is most sensitive to inflation, to fiscal risk and central bank credibility, well, that's blowing up. The Bank of Japan is sitting on its hands and everyone's asking, what broke? Well, the answer is everything. Fiscal credibility, investor trust, central bank omnipotence, the illusion that governments can always fund themselves at low cost no matter the debt load. And here's the scary part. Japan, well, that's just the start. The metaphor doing the rounds is that Japan is the fuse, the US is the bomb. And it's uncomfortably accurate because what's unfolding in Tokyo is already being echoed in Washington. In the US, a 20-year Treasury auction this week also shrugged, the highest coupon since the maturity was introduced. Primary dealers had to mop up nearly 17% of issuance. That's not healthy, that's desperation. And yields are rising. The 30-year Treasury is pushing above 5.1%. The S&P 500 is wobbling. And the so-called bond vigilantes, the very ones who discipline governments for overspending, well, they are saddling up again. Moody's has already stripped the US of its AAA rating. The market is starting to listen because America isn't just borrowing a lot, it's borrowing irresponsibly. In fact, let's just talk about Trump's new bill, which is officially known as the One Big Beautiful Bill Act. This is the proposed revival of his 2017 tax cuts. More giveaways, less revenue, and according to the Committee for a Responsible Federal Budget, an extra $3.3 trillion in public debt by 2034. So this bill would push the US debt to GDP ratio to 125%. And here's the kicker. This is happening when $9 trillion in US debt is maturing within the next 12 months. That's not just a mountain, that's Everest on speed, rolling towards another cliff. As Ray Dalio put it, it's like being on a boat heading for the rocks and the people steering, they're arguing over which way to turn. Anyway, I digress. Back to Japan. The yen carry trade has been one of the biggest engines of global liquidity since the late 90s. Borrow cheap in Japan, invest abroad for higher yields, rinse, repeat, and lever up. But now, Japanese yields are rising, and the strategy that once seemed foolproof is rapidly collapsing. Trillions of dollars tied up in global carry trades are being unwound as capital flows back to Japan. Investors are offloading foreign bonds, reversing years of outbound investment, and in the process, the yen is beginning to strengthen. This isn't just a Japanese problem. This is a global margin call. Emerging markets, many of which benefited from Japanese capital seeking returns, are now vulnerable to sudden outflows. Liquidity is evaporating, FX volatility is surging, and even US markets are feeling the tremors. When Japanese institutions stop buying foreign debt, or worse, start selling it, the whole house of cards creaks. And here's the strategic implication. If Japan breaks, the US cannot survive unscathed. The US relies on foreign buyers for its treasury market. If they step away or if they demand high yields to compensate for risk, then US borrowing costs surge. Full stop. We're not talking about inflationary pressure here. We're talking about a structural breakdown in demand. And as always, this is about something else than the surface headlines. In this instant, this is about more than bond yields. It's about belief. For decades, central banks have told us that they can control markets, that they can suppress volatility, that they'll be there always to make sure nothing breaks. But something has broken. Right now, in real time, the Bank of Japan is no longer in control of its yield curve. The Federal Reserve is watching its long end rise, and the European Central Bank is whispering about tightening into a stagnating block. Confidence in central planning, in paper promises, and monetary omniscience is cracking. And when that happens, capital doesn't wait, it runs. Now, even more people are asking, is this the end of dollar dominance? Not quite. The dollar has no serious challenger yet. The euro is too fragmented. The renminbi is too controlled. There is no liquid, free-floating, geopolitically neutral alternative. But trust in the dollar is eroding, not because of competition, but because of self-harm. Fiscal recklessness, political dysfunction, weaponization of the dollar in global trade disputes, the world is noticing. And as history shows, trust in a currency isn't lost overnight, but once gone, it rarely returns in full. So with all this, I do wonder how we'll bring all of it to a conclusion. Gold? Because gold doesn't promise a coupon. It doesn't promise intervention. It doesn't run deficits, rig interest rates, or tweet about tax cuts. Gold just is. And in a world where sovereign debt is wobbling and faith in central banks is fading, well, gold looks increasingly attractive. Because it's not just a hedge, it's a judgment on the system, on debt, on fiat, on the idea that governments can pile up obligations forever and expect markets to just applaud. Well, Japan's market just stopped applauding, and the US could be next. So if the fuse is lit, how long until detonation? We may be watching the end of the sovereign bond repression regime, the era where governments printed, borrowed, and suppressed their way to growth without pain. That illusion is dying in Tokyo, and a bit like a dodgy business trip, what starts in Japan never stays in Japan, because the global system, from FX markets to collateral trains to interest rate expectations, is built on the back of sovereign debt markets. If Japan breaks and America cracks, there's only one question left. What can't they print? What don't they control? What still holds value when the trust is gone? That is why gold matters. Because when the fuse is lit, you don't stand next to the bomb. You move. You head to the exit. And that's the very reason why we prepared the exit plan for you. Download it now. Links in the comments.